Remember, I used to think that trading was basically gambling until I learned how to actually properly read and use the EMAs. And now I can't imagine trading a single day without using them, and hopefully you won't either after this video. So let's start with what a moving average even is. Well, it's an indicator that essentially just takes past prices, averaging them out into one line. So instead of trying to interpret every tiny little move in price, you get a bigger picture of the overall trend. The smaller the number, the faster it reacts to price, whereas the bigger the number, the smoother and slower it becomes. For example, the 10 EMA is averaging out the last 10 candles, the 20 EMA the last 20 candles, and so forth. And the exponential component basically just means that it's going to give more weight to recent price action. So it is more reactive than just a normal moving average. When I pull up a chart here, I'm just going to use Tesla as a random example. But the first thing that I really use EMAs for is identifying the overall trend direction. With my breakout strategy, I'm really only looking to trade stocks that are already in strong uptrends, and that is when I mainly use the 50 and the 200. So if price is consistently holding above the 50 and 200 EMAs over time, then that's usually a sign that the stock is in a healthy long-term uptrend. But when price starts falling below those levels, losing them repeatedly or failing to reclaim them after breakdowns, that is usually a sign of weakness or a potential trend shift. Now, for longer-term buyers, the 200 EMA can also be a really useful area for finding dip buying opportunities because, stocks never move in a straight line forever. They will break out, pull back and consolidate, and then continue trending higher. And if you look closely, a lot of those pullbacks tend to happen around these moving averages before the next leg higher begins. So in strong uptrends, the 200 EMA can almost act like a dynamic support level where buyers are consistently stepping back in. But once price falls below it, now that same level can start acting as resistance instead. So you'll often see, price rally back into the 200, fail, and then sell off again, try to reclaim it again, and eventually either break back above or continue lower. Now, in my strategy specifically, I use the 10 and the 20 EMA the most. So the 10 is the blue line here and the 20 is the yellow line. And one thing I pay really close attention to is the relationship and the spacing between them. So when all of these moving averages are tight together, there usually isn't a strong trend in either direction. And that's where the market can get really choppy, price starts moving sideways, and traders will get chopped out here over and over again. So I usually avoid buying in those conditions because there's just no clear momentum yet. But compression like this can also become important because when price keeps tightening into a smaller range, it's often building energy for a larger move later. So as I've shown you guys before, this is basically the ideal setup for my breakout strategy. Higher lows are forming, lower highs are forming, price keeps compressing tighter and tighter into that triangle formation, and then eventually price expands out of that range on strong volume. Now, if we zoom in here, I only want to be buying when price is above the 10 and the 10 is above the 20 because that tells me that short-term momentum is stronger than the slightly longer-term average and the stock is still holding strength. And then once I'm actually in the trade, I will use the 10 EMA to help manage the position. So as long as price continues holding above the 10 EMA, I'll usually continue holding because momentum is still intact. But once price starts consistently closing below the 10 or especially starts losing the 20, that's when I start paying attention because momentum is weakening. Now, the reason that I buy close to the base of the breakout instead of chasing an extended move is because the further price gets away from these moving averages, the harder it becomes for that move to sustain itself without eventually pulling back, which also means that your risk increases significantly when you chase those. Even shorter term traders will sometimes use the 10 EMA almost like a dynamic support level. So you'll see a stock break out, it pulls back towards the 10, hold that area, then continue trending higher again, which you can see happens multiple times here. Now, EMA crossovers can lag. So while I do pay attention to when the 10 crosses below the 20, a large part of that move has already happened. So that's why I use EMAs more as a framework for understanding trend, momentum, structure, and trade management rather than just, blindly reacting to indicator signals. In my next video, just based on a lot of the messages I've been getting from you guys, I want to jump into trading psychology, which is absolutely essential. And I might do like a 3-part mini series on it. But please continue to leave your questions in the comments down below. It really helps me just figure out what you guys are struggling with. I will continue to make videos answering them as well.